Good morning, class. You are welcome to another session of the course titled Banking and Financial Environment with the code FIN 317. My name is Dr. Ajibola Olurotimi, and specifically today we are going to study session 15 titled The Financial System and Policy Implication. And at the end of this session, you should be able to 1. Explain the meaning of monetary policy framework. 2. Discuss the relationship between monetary policy tools, targets, and goals. 3. Explain the different strategies of monetary policy with a set instrument, target, and long-term objectives. 4. Discuss price level targeting, inflation targeting, and exchange rate targeting. We start with what is a financial system. A financial system is an economic arrangement wherein financial institutions facilitate the transfer of funds and assets between borrowers, lenders, and investors. That is, in a financial system, you find the deficit sector and the surplus sector coming together to facilitate financial transactions. And the goal of that system is to distribute economic resources to promote economic growth and return for the investors. There are 5 basic components of financial system. The first one is financial institutions, which comprise of those institutions that operate in that system. The bank, commercial banks, and other banks that operate in the system. We have the financial markets, which can be segmented into the money market and the capital market. Then there are the financial instruments that are traded in the market, like treasury bill, treasury certificate, government bond, and so on and so forth. Then we have the financial services. Those are the services being carried on in the system. And of course, money, which is the stock in trade in that market. Then the importance of financial system. The first importance, which is very important, is it's an avenue to raise short-term and long-term funds to government. Apart from that, it provides funds to the investing public. It mobilizes savings from the public. And of course, it efficiently allocates financial resources among the participants in the market. Monetary policy is very important in this segment, and it comprises of the tool of general macroeconomic management under the control of monetary authority, and is designed to achieve government economic objectives. Monetary policy, they are measures introduced by government through the central bank to influence the macroeconomic objectives. And monetary policy, they are set to achieve certain objectives, which include to reduce unemployment rate. They are also to reduce inflation rate. Monetary policy, they are meant to stabilize the financial markets, and of course to ensure that exchange rate is stable for at least a considerable time. And they are set also to achieve growth in the economy. The instruments that are used to achieve these objectives include the reserve requirement, which is a proportion of the bank deposit that must be kept with the monetary authority, that is the central bank. Interest rate is also one of the instruments which of course determine how much bank will set or will charge on money lent out. Open market or operation is also an instrument of monetary policy, which comprises of the buy and selling of security by the central bank to influence the level of money supply Discount rate is another instrument of monetary policy, which of course is the rate at which the central bank lend to other banks. Then the required reserve requirement. Now we move to strategies of monetary policy targeting. We have first the monetary targeting approach. And in this approach, the central bank, they monitor the growth of money supply by predicting the future money supply and thereby the inflation. When they are able to predict that rate that they are targeting in the future, they now put everything in place towards achieving that target. We have the price level targeting. That is the authority. They look at the past year's price level and now determine what the future will be. And they try to use different tools to achieve that by targeting future prices for goods and services. We have inflation targeting. This one also, the central bank estimates projected inflation rate and employ monetary tools towards achieving the projected rate. We have exchange rate targeting. The value of currency is fixed in relation to another basket of currencies. Government will determine what will the exchange rate be and how do we achieve that. That is exchange rate targeting. Now, having gone through all this, there are some questions that I want you to lay your hands on. The first one is discuss the relationship between monetary policy tools and goals. The second one is briefly discuss price level targeting. And the last one is differentiate between inflation targeting and exchange rate targeting. Now, when you lay your hands on this, you see that we have gone far and you'll be able to assess your understanding of today's lecture. In summary, today we have learned the meaning of monetary policy framework. We have also learned the factors that influence the CBN choice of monetary framework and the relationship between the monetary policy tools target and their goals. We have also looked at the strategies of monetary policy targeting. Thank you.